Welcome to this explainer. Today, we're doing something really exciting. We are taking a journey to shift your mindset. We're moving away from just hustling for active income, and we're talking about building real, true passive wealth. We're diving into the absolute engine of wealth creation, the power of compounding. Specifically, we're going to look at how compound interest can take a simple savings habit like 1,000 Kenyan shillings a day and turn it into real wealth. Let's get right into it.
So, can saving just 1,000 bob a day actually make you a millionaire? I mean, it sounds like a pretty massive promise, right? But throughout this explainer, we're going to break down the exact math behind this. We'll see how totally accessible daily amounts can create massive wealth over time. And trust me, the numbers we're about to look at, they prove without a doubt that you absolutely do not need to start rich to finish wealthy.
All right, Section 1, active hustle versus passive wealth.
Think about a self-employed individual or, a freelancer. It's a great hustle, but it heavily relies on your direct control and your personal expertise. The major flaw here? Scalability. If you stop working, well, the income stops immediately. True financial freedom means transitioning to a passive wealth model. It's about building a system where your money actually acts as a system, making you more money entirely independent of your daily active effort. It's basically making money while you sleep.
Moving on to Section 2, the engine of wealth. To make that passive wealth transition, you really need to understand compound interest. Basically, this is interest calculated on your initial investment plus all the interest that has already been earned over time. It is literally the engine of wealth creation. So instead of just your initial cash working for you, your returns start working for you too. It creates this incredibly powerful snowball effect.
The difference between simple and compound interest is honestly staggering. Simple interest, it only pays out on your original principal, so just grows in a predictable, flat, linear line. But compound interest accelerates exponentially. At first, it looks kind of similar, but as that interest-on-interest effect really kicks in, the growth just shoots straight upward. That exponential curve right there is the ultimate key to massive long-term wealth.
Okay, Section 3, the math of doubling. 72. Now, this isn't just some random number we pulled out of thin air. This magic number is the key to a famous and honestly incredibly useful mathematical shortcut. It's known as the Rule of 72.
Here's how you actually use it. You take the number 72 and divide it by your expected annual interest rate. That simple calculation instantly tells you exactly how many years it will take for your initial investment to completely double in size. So for example, if you invest money at a 6% annual return, well, 72 divided by 6 equals 12, meaning your money doubles every 12 years. It's such a brilliant instant tool to evaluate literally any investment.
And here's another incredible mental model for you. The 8-4-3 rule of compounding. Assuming a strong, consistent interest rate, your initial money might double in roughly 8 years. But if you just leave it alone, it grows to 4 times its original size in 16 years. Leave it again, and it grows 8 times in 24 years. This perfectly demonstrates why giving your productive assets time in the market is just far, far more important than trying to start with some massive lump sum later in life. Time is your secret ingredient to getting that 8x multiplier.
Section 4, 1,000 shillings a day. Let's apply this to the real world. Over a 20-year period, your monthly contributions lead to radically different destinations. A contribution of 5,000 shillings looks very different from 20,000. But remember our main theme today. Setting aside just 1,000 shillings a day equates to roughly 30,000 shillings a month. If you can push your contributions to that level, combined with the sheer power of compounding, you create a staggeringly different millionaire-level destination over 2 decades. It's a total game changer.
So you're probably wondering, where exactly do you put that 1,000 shillings a day? Well, Capital Markets Authority licensed money market funds, or MMFs, offer really impressive daily yields. If we look at the top performers right now, according to a snapshot from PesaCalc, we see funds like Nabo Africa at 13.8% gross and Citon at 11.9%. But hey, here's a really vital tip. Always focus on the net yield. That's your actual take-home return after the mandatory 15% withholding tax is deducted.
All right, Section 5, when compounding works against you. This is crucial. What happens when this beautiful exponential curve is flipped upside down? Well, when compound interest is applied to high-interest debt, especially debt with very frequent compounding periods, like daily or monthly, that awesome wealth-building snowball effect we talked about, it quickly turns into a devastating financial avalanche. Let's bring back our rule of 72 to see this in action. Say you have a savings account yielding 6%. As we know, it takes 12 long years for your money to double. But what if you have an unpaid balance of just 1,000 shillings on a credit card charging an 18% annual interest rate? 72 divided by 18 is 4. That unpaid balance will completely double in just 4 short years. You can see how this rapidly escalates your financial strain, right? Compounding doesn't care if you're saving or borrowing. The math works exactly the same way.
Section 6. Reality check. Taxes and risks.
Look, your nominal growth isn't always your real wealth. Why? Because there are, let's call them villains, trying to slow your money down. You always have to factor in that 15% withholding tax. You also have to account for management fees, which typically run between 1.5% to 2% a year. Then there's the silent theft of inflation, slowly reducing your purchasing power. And finally, the inherent risk of investing. Market returns are simply never guaranteed. You really must navigate these realities to win the wealth game.
But despite those villains, the investment landscape is becoming incredibly democratized. Major institutions like Safaricom have actually noted in their annual reports that they want to bring down the savings threshold to less than 100 shillings for vehicles like unit trusts and treasury bonds. So what does this mean for you? It means you literally have 0 excuses left not to start today. You don't need a massive lump sum. You can start with literal pocket change and let time do all the heavy lifting.
And that brings us to our final thought. You now know the mechanics of the engine of wealth. You understand the rule of 72, and you've seen the very real difference between a flat linear climb and explosive exponential growth. The truth is, your money is compounding right now as we speak, so I want you to take a close look at your savings and take a really hard look at your debts and decide what side of the math do you want to be on. Thanks so much for joining us for this explainer, and we will see you next time.